everyone, welcome to Pop Quiz for the MLO tests. My name is Lance and I'm here with my friend Samantha, and we're just gonna roll through these pop quiz questions, all right? So make sure that as you're going through this, try to answer the question before Samantha answers it, right? You know what I'm saying? Really try to use this video as a tool to really quiz yourself, right? We're gonna go through a lot of questions. It's gonna be amazing, amazing. I'm really excited, really appreciate Samantha for joining me on this video. It's gonna be awesome, awesome, awesome. So,
yes. Hi guys, I'm looking forward to this. Hopefully it's helpful to you guys as well.
yes. So now, Samantha, question number one. What is the secondary market?
So the secondary market is for private investors to buy or sell secondary mortgages.
Mm-hmm. Can consumers get mortgages from the secondary market?
No, they can only access from the primary market.
What does GNMA stand for, and what's the nickname?
GNMA stands for Government National Mortgage Association, and the nickname is Ginnie Mae.
Who owns Ginnie Mae?
HUD, which is the U.S. Department of Housing and Urban Development.
Does Ginnie Mae buy or sell loans or issue mortgage-backed securities?
No, they do not. They only insure and guarantee, I believe.
Insurers and guarantees.
Is that correct?
Government loans, right? They only insure or guarantee government loans. Awesome. So, okay, so that leads into but to be more specific, what does Ginnie Mae do? So Ginnie Mae guarantees, insures what? Investors.
So they guarantee investors like timely payment of the principal and interest
yes.
on the mortgage-backed securities, which is MBS.
Right.
On the guaranteed loans.
Right. So mortgage-backed securities, by federally, by federally insured or guaranteed loans. Right. That's right. Very good. Very good. Awesome. What are the loans Ginnie Mae guarantees or insures?
So it's FHA loans, VA loans, USDA, and I think that's it. Those three.
Very good. Now let's get a little technical then. So which loan does it insure, and then which loans does it guarantee?
So I know like the VA and the USDA, it guarantees. Yes. So the FHA, it insures.
Yes. What is a GSE?
So that's a government-sponsored enterprise.
Okay, or is it government-sponsored entity? No, you know what though?
Oh, yes. Thank you, Lance. Government-sponsored entity.
Okay, awesome. I feel like I've heard some people say enterprise though, but I guess.
Yeah, I was about to say, where am I getting the enterprise? I feel like.
I remember people saying that, so I'm just thinking, is it?
I wonder if it's interchangeable, but government-sponsored entity. Actually, I'm pretty sure enterprise is used as well, but don't quote me on that.
Right. So guys, look that one up. Look that one up.
Exactly.
Government-sponsored entity, or is it government-sponsored enterprise? Please type into the chat box, your answer to that, right? Okay. So so that one we need to double check that one, is it enterprise or is it entity? Okay. Now, so what are two examples of GSEs?
Fannie Mae and Freddie Mac. So Fannie Mae is FNMA and Freddie Mac is FHMLC.
Yes, very good. What does AUS stand for?
The Automated Underwriting System.
Excellent. What is Fannie Mae's automated underwriting system?
It's called DU, which is Desktop Underwriter. Desktop Underwriter.
What is Freddie Mac's AUS, and what did it used to be called? Well,
I know so Freddie Mac is Loan Product advisor, and it used to be called, I think it used to be loan prospect or something.
Yes. Loan
Is that right?
Yeah, loan prospector. That's right.
Okay.
That's right.
Okay.
Or LP. Used to be called, LP loan prospector, right? Yeah.
Yes.
Formerly it was that, but now it is loan product advisor, right? All right. What is the 2021 conforming loan limit?
So the loan limit for this year is 548,250. And just to elaborate on that, I know that it's going to be changing, but for like test purposes, if you're using this for the test, then you just need to know 548,250. You don't need to be concerned with what it's going to change to for next year
Mm-hmm.
because it's not been released yet.
Mm-hmm. Are conventional mortgages assumable?
No, they have a due on sale clause.
On a conventional mortgage, can a down payment come from a gift?
I believe so. I think, yes, it can come from a gift. And I know that I'm pretty sure it has to have a letter stating that it doesn't need to be repaid.
That's right.
However, with the conventional, the borrower has to also put down, I think they still have to put down, oh, I don't know the percentage. I don't know if it's 5%.
5%.
You know,
Borrower needs
Lance?
to put 5% down of own funds.
Okay.
All right.
Okay.
Which is what I have on, what we had in our document though. But I mean, you think that's,
Yes, I'm pretty sure that that's
what it was.
that it was 5%. I just yes, and I know because then I think we'll have like one of the questions later, but
That's right, for FHA.
with FHA, yeah. So we'll get to that.
Yeah, it's coming now. But now to clarify though, you mentioned a letter. What's the name of the letter? It's called a
Is it like the gift letter?
letter. That's right. Yes, a gift letter.
Okay.
Right, that's the name.
Okay.
Right. On a FHA loan, what is the minimum down payment, and can it be a gift?
So the minimum down payment is 3.5%, and it can be a gift.
Yeah.
And again, like they just need the gift letter stating that they do not, that it doesn't have to be paid back.
Yes. What is the definition of debt service?
So debt service is I think it's equivalent to the monthly principal and interest.
Yes.
Is that right? Okay.
P and the I, right? Yes.
Or yeah, P&I.
Right. When a borrower pays late fees, what do they pay it on?
So they just pay on the P&I, which is just the principal and interest. So not the taxes and insurance.
Right. What is PITI and what's another term for it?
So PITI is principal, interest, taxes, and insurance, which is I guess the acronym is PITI. Is that what you're asking?
But now it's also let's see, what's another term for it? So let's see. Okay, now let's clarify. When you say insurance, right? You said principal, interest, taxes, and insurance. What type of insurance is included in that phrase, insurance?
Okay, yeah, that's a great question. The hazard insurance and flood insurance.
And hazard insurance, flood insurance, and also the big one, the most.
Oh, the property taxes?
No. That property taxes.
Oh, the mortgage insurance.
Mortgage insurance. Right. All right. So principal, interest, taxes, and insurance. And insurance meaning hazard and flood and mortgage insurance. Right. All right. Now, in our document, we talk about, let's see, AKA monthly housing expense divided by front end ratio or housing ratio. Okay, so this is kind of like a separate thing, but I guess you're talking about when calculating the front end ratio. Yeah.
Oh,
Okay.
okay, so the monthly housing expense divided by the front, oh no, the monthly housing expense in the front end ratio. I think, you know what, that's gonna come up later, so let's, I don't want to confuse anybody with
Yeah,
that.
it's kind of confusing. Yeah. Okay. And I'll make a note. We can adjust that. Okay.
Okay.
What is the largest investor in the secondary mortgage market? Or who is it?
Fannie Mae.
Yeah, Fannie Mae,
Fannie
right?
Mae.
Okay. Does Fannie Mae purchase balloon mortgages?
No,
No. Okay.
definitely not.
What type of mortgages does Fannie Mae not purchase?
They don't purchase agricultural,
Right. Right.
so that's like farm,
Or
farm ranches, undeveloped land, that kind of thing.
right. That's right. When was Fannie Mae created and what exchange was it eventually listed on?
So I know it was listed on the New York Stock Exchange, and I
Eventually.
believe it was created in 1938.
Right. So it was created in 1938 as a government agency and then eventually listed on the New York Stock Exchange. Excellent. What is the main purpose of Fannie Mae?
So to buy and purchase property, or purchase loans from the primary market.
So to buy mortgages and notes from primary lenders so money remains in circulation.
Okay, so can you repeat it one more time?
Yeah, so the main purpose of Fannie Mae is to buy mortgages and notes from primary lenders so money remains in circulation.
Okay, all right, got it.
But you know what? I wonder if maybe we should come back to that one to kind of clarify it more, because is it like, buying on the primary market? You know what I'm saying? Like,
So yeah, that's where, I mean, I do believe so I know, like within like Rocky Study Group, when we were talking about this, I know that we've talked about for the money, so the money remains in circulation, like part of the purpose. As far as the where it says to buy mortgages and notes from lenders, I think that just so it's not confusing for everyone, we can come back to it and we can maybe ask, but
right.
I think I mean, I do know they're buying from the primary market.
Right. Okay.
So yeah, that might be one we just need to come back to, so it's not confusing.
Yeah. All right. How many mortgages will Fannie Mae allow on a principal property?
They do not have any limitations on how many.
And how many mortgages will Fannie Mae allow on a second home or investment property?
They allow a maximum of 10 to be financed.
How many credit scores does Fannie Mae require for each borrower?
So at minimum 2, which they would use the lower of the 2, I believe, or else it would be 3 from the 3 credit bureaus, which is Experian, Equifax, and TransUnion, and then they would use the middle score of the 3. And then also to elaborate on that, if you have, say I'm the primary and I have a co-borrower, they would use the middle score of the lowest. So say I have the lowest middle score, then they're going to use the lowest for myself.
If there is more than one person on the loan, what is or who is the representative score used?
Okay, sorry, that was pretty much what I was just.
Okay, yeah, that's what you were just saying. Yeah, that's right.
Yeah.
Mention that. Okay. Yeah. Okay. What is an Alt A loan?
So it's a loan that doesn't have that much. There's not much documentation. So like on income and assets, I believe.
Right. Okay. So yeah, a loan with reduced documentation, high ratio, or limited assets.
Okay, so high, like DTI, like debt to income.
Yeah.
And
Yeah.
then limited assets. Okay.
Assets or reduce documentation, right? Yeah. All right. What is amortization?
So when you have a loan and you're paying off, you're making regular payments. So on like the principal and interest consistently. So
Mhm.
I'm trying to think. I feel like there's more to add to that though.
Okay. So another way of saying it, fully paying off a loan in regular payments over a period of time, and payments go towards principal and interest.
Okay.
Mhm.
Okay.
Now, what is negative amortization?
Okay. So I guess so if you're not paying on like interest, like the interest for
If
it.
you're not paying enough of the, you know what I'm saying? Like if you're,
Oh, right. Because you could be
remember we
making,
talked about how if it doesn't cover at least the interest, it had that the part that's missing has to be added to the principal, right?
right. So it gets just kind of like tacked on to the end of it, which would mean, so you're not, again, going back to the definition of, with it like of a positive amortization, you're not making like those regular payments because you're not paying enough on the interest. So then you end up like at the end of the loan, it's not pay, like you still have more to pay, right? Is that
Right. So another way of saying it is when monthly payment is less than the interest due, so the unpaid interest is added to the outstanding balance. So the balance is increasing because the monthly payment isn't sufficient to cover the accrued interest from the previous month.
that is much better than what I said. But
But you get it though. You get it.
yes, yes, absolutely.
Yeah, good. What is a senior mortgage?
That's the like a first mortgage that has like the senior loan position.
Mm-hmm. What is a let's see, yeah, what is a junior mortgage?
So a junior mortgage, I think like the wording that we use for study purposes is a subordinate like lien position. Is that right? Something
Okay,
like that.
okay, subsequent mortgages, right, has a
Mhm.
more subordinate position than
Oh,
senior mortgage.
okay, subordinate, so lesser position. So your senior mortgage is here, and then obviously like the okay.
Because remember when we were describing the senior mortgage, we're saying a first mortgage, right?
Right,
Has a
right.
superior lien position. And so a junior mortgage is subsequent mortgages and has a more subordinate position than the senior mortgage. Mhm.
Okay.
What is a fixed rate mortgage?
So I think I'm gonna need help.
Okay,
Well, I get,
so
yeah, I
an
don't want to
example,
confuse. So can you help me?
yeah, an example of a, let me see, wait a minute. All right, so an example of a fully amortized loan, right? In the beginning, the majority of the payment goes to interest, but the payments in the last few years are going to principal. So wait, is this the right? All right, so let's look at our document on this one. It's 35,
Okay.
number 35. So
Okay, so
so a fixed rate mortgage, right, is where the interest rate is fixed, right? It's not variable, right? It's not like
right,
adjustable.
so you have like, I mean, if you like, let's just say like you have a 3.25
Fixed,
interest rate, right? So it's going to stay the same. It's not going to fluctuate like it would in
like a
an
car.
ARM, for example, that's adjustable.
Right.
So
Yeah.
so I mean, I'm thinking of it like, I mean, you think about like your payments, like initially how you, most of them, like whenever you get like say like the table from when you're paying on your mortgage or even a car note, like where it pays off initially, like there's paying on a lot of the interest, and then just like a smaller amount is going to the principal,
Exactly.
right?
Right.
But then at the as the payments in the last few, like the last few years of the loan is just going to the principal because you pay the interest.
Right.
So
That's right.
it's
That's right.
amortizing.
Because they amortize, right? And the reason why is because in the beginning you have this high balance, right? But then as you're paying, each payment is paying the interest, but also it's taking, and then it's decreasing the principal, right? And as the principal is decreasing, then you don't need to pay as much interest, but you're still paying the same amount of payment. It's just that more of your payment then is going towards the principal and less of your payment.
Yes, that was so, yes, I'm sorry to cut you off, but that was so good what you said about pointing out that you're still making the same payment, but just as it's amortizing, like towards the end, it's going more towards the actual principal instead of what you're paying to get the loan.
Right.
Yeah, that was good. That was good.
Excellent. What is a balloon mortgage?
Okay, so a balloon mortgage, so a balloon mortgage is where you can have, I believe, like you can pick like the number of years, and some common examples would be like 5 years, 7 years, or 10 years, but where you may, I think there's a couple different kinds, like for one, maybe an interest only, where you're just paying on the interest for, let's say 7 years. And then come year 7, you have to pay in one lump sum the remaining balance.
Balance of the principal, right? You pay.
Yes. And then, yeah. And I believe there are some where you can pay on the principal and interest.
Right.
And then, whether it's year 5, 7, or 10, then you pay the remaining balance. And then think about it, if you're paying on the principal and interest, then your balance, that lump sum, is going to be less because you paid more,
Right.
So
good point. Good point. Excellent. What is a 360/180 loan?
So, okay, so this one is where, so it's a balloon mortgage that's amortized. So the 360 is the number of months. So if like you have like a regular, like an amortized loan that is 30 years, that's 360 months. And then the 180 is the number of months for 15 years. So 15 years times 12 months is 180, right? So it amortizes over the 30 years, but then at year 15 is when you pay the remaining balance off. So you make payments all the way up to year 15, and then at year 15 you pay the remaining balance off. I think that's,
yeah, that's good. What is an ARM and what is it made of? Which part fluctuates?
Okay, so the ARM is an adjustable rate mortgage, and it has the index, which fluctuates, and then the margin, which is fixed.
What is an index?
So that's, again, like it fluctuates, and I know like the lender doesn't have control over it. And I believe, because it says like it's an economic indicator, so I'm
right, it's an economic indicator
based, so it's going to go up and down. Again, like we as lenders or potential lenders or future lenders, we don't have control of that, right?
Very good. Yeah. Now, what are some examples of indexes? Like there's on Jen's cheat sheet. Shout out to Jen for that amazing cheat sheet.
Yes, Jen.
Has 4 indexes, or I guess you call it indices or something. I don't know.
Yes. Okay.
Wait, what are they? The 4.
The 4 indices. That is prime. Coffee. Yeah, coffee. Is it coffee or coffee?
Okay, how's it spelled?
COFI.
Right.
So I think it's coffee, and then COSI, which is COSI, and then the LIBOR, which is LIBOR, and then prime. Those are the 4 indices.
Excellent. And what is the margin?
So the margin, which again is fixed, is added to the index, and that's all I know.
Okay, so yeah, so the margin, right, is a fixed percentage added to the index at each adjustment period, right? And so fully indexed rate factors in lender's profit and overhead. Okay, so but
Okay.
basically, right? Well, go ahead, go ahead. You got
Yeah,
it.
so this like so the index and the margin equals the fully what was it, the fully index rate.
Right, fully indexed.
So
Right. Oh, I see. Right. All right. What is a mortgage spread?
that is the profit that the lender makes.
What is an adjustable? Oh, what is an adjustment period?
So I believe it's like when so if you have an adjustable rate mortgage, it's like the period from when the first adjustment happens. Oh, I think I'm getting confused. Can you help me on this one,
Okay.
Lance?
Adjustment period specifies the initial term before the first interest rate adjustment and usually adjusts every year.
Okay, so the initial term before the first adjustment and then adjust every year after that. I mean, that can doesn't necessarily mean it's always every year, contingent on I guess it's contingent on the adjustment periods that you choose in different caps, right? Like, so if it's well, you know what, actually, I think when we explain like
Okay.
the rate cap, it
Yeah.
will
Yeah, we'll give them
make a little bit more sense.
on that. Yeah, because I think that term, I mean, that explanation can be a little confusing that we have.
Right.
Okay. All right. So
Right.
yeah, so let's talk about this then. What is the rate cap? Or let's see. Yeah, what is the rate cap, and explain cap 2/3/6.
Okay, so if you have an adjustable rate mortgage that where you see like 2/3/6, the 2 is like the first adjustment. So that's the percentage that it can adjust the very first time, the initial
So
time.
it's the maximum, right? You're saying, right? When you say
Oh yes, sorry. So the
maximum.
maximum amount that first adjustment can be, which
Right.
is 2%. That's the max. Good, thank you for pointing that out. And then the second one, so the 3 that's the periodic
adjustment. The
adjustment.
maximum, right? The maximum periodic.
So that's like let's see. So is that like, so the periodic adjustments of 3%? So, okay, so to go back, I'm sorry, I don't want to confuse everybody. So the first one is like the initial adjustment, the max that it can be, which is the 2%. And then the 3 are the regular periodic adjustments. And the last one, the 6, is like the maximum amount. It's like the lifetime cap, the maximum amount that it can adjust over the life of the loan, which is 6%.
Right. And when you say a lifetime maximum, it's based on like the maximum based on the initial, right? Like based on the starting interest rate, I guess you could say, right?
Yes, exactly.
Okay.
Exactly.
Right. The maximum. Okay. So to give people a real good example, let's say that it's an arm and that it starts at 5%, right? And it's a 2/3/6, right? So how would that look then if we're starting at 5%? So the initial.
So if we start at 5%, then the initial it can go up to 2%, right? So the max it could be would then be 7%.
Right.
Is that right?
Right. That's right, for the initial, right? And then periodically, right?
So and then the periodic, if it's 3, it can go up or down 3%.
Right.
right? So it could be, so although if it's at a 3, and it can get, if it goes to from 5 to a 7, and then it can go up or down 3%. Okay, yes, then it's, and then the last one would be like the 6%. So that's the max that it can go over the entire life of the loan. So
Right.
if we started at 5, then it can't go any more than 11. Isn't that correct?
That's right. That's right. So just to play it out, I mean, so it could go. A scenario could be where the first adjustment went from a 5 to 7. You know, it could do that, and then it could, and the next adjustment, it could go up to a 10, right? Because the 3 is the maximum, but it's the maximum based on the previous, right? So it can go from 7 to 10, right?
Yes.
But then in the next one though, right, it could only go from 10 only up to 11. It can't go more than 11, right? Because the 11% is the maximum interest for this particular scenario, right?
Exactly.
Yeah.
Exactly.
Okay, cool.
Yes.
Cool. All right. Is a rate cap beneficial? And if yes, who does it benefit?
Yes, it's beneficial to the borrower. So it's beneficial to the borrower so that you know, like, so you know how high, like it can't keep going past a certain point,
Mhm.
right?
That's right. That's right. So yeah, beneficial to the borrower. So lender can't change more than the caps, right? And so it
Right.
controls what type. There's a term about the shock. Remember?
Oh yes, that it's called payment shock.
Yeah.
So
Yeah. But it helps prevent payment shock, right? Yeah. Yeah.
yes, yes,
Yeah.
yes.
What is a biweekly mortgage payment, and what is the benefit?
So it's when you pay, you make your payments every 2 weeks.
Mhm.
So if it's bi-weekly, then there's 26 weeks in the year. So you are basically making 2 extra payments. So you pay off the loan faster.
What is a term mortgage, and what is the balance due at the end of the term?
So this is a non-amortizing loan. So it's non-amortizing. Oh, Rocky just gave this to me the other day.
Now to clarify, non-amortizing interest only loan.
Yes, yes. So non-amortizing interest only loan where the balance is due, like so there's a balloon payment at the end, like one lump sum.
Balance is due at the end of the term as a balloon payment. Right. Right.
So
Right.
and one lump sum. Okay.
What is net tangible benefit?
So that is like when, like if we're doing like refinances, we have to make sure that there is, like, let me try to talk this out. Like, so when you're doing a refi, like there's like calculations that lenders do to make sure like where you can see where the break-even point is. So you make sure that there's, obviously it's a benefit to the consumer or borrower or homeowner, so that you're not so that it's doesn't what is the term, like I think it's like equity stripping.
Oh, equity
Is
skipping.
it something like that? Like
Yeah, yeah, where basically where it's like it should be worth it, right? Because you don't, it
exactly.
shouldn't be where you're abusing the borrower, where the borrower is having to pay more to do the refinance, than the benefit that they're getting from the refinance, right? So it has to make sense, right? Yeah,
Yes,
be worth.
yes.
Yeah, that's awesome. But yeah, I know what you, and I think it's going to come up about the equity skimping and all that stuff. Yeah.
Yeah, it's like equity stripping. I mean, because I mean, think about it. If we like
Right.
they have they're refinancing, they have equity built up in their home.
Right.
But if lenders are actually, they're doing loans that are not really quality loans, then if there's not really a net tangible benefit to the to the consumer, then we're like, it's equity stripping. Like,
Right.
yeah.
And on your definition on the document about net tangible benefit, so refinance loans must make sense for the consumers, and the cost of the commission of the loan can't be larger than the benefit the consumer receives, right? So basically,
Yes,
right,
yes, yes.
has to be worth it, right? What is a reverse mortgage?
So this is for people who have a lot of equity in their home. They are I think it's a negative amortizing loan. They have a lot of equity and they have to be 62 years or older to qualify. But I might need some help on
a primary residence.
Yes. Yes. Oh, and I know that the lenders cannot go after, like, so if they pass away and there's whatever is left in their loan, that like lenders cannot go after their heirs for that.
Right. But of course, like the home won't go to the heirs though, right? The lenders will take the home, right? Okay.
Correct. Good point. Yes. Yes. They just can't like go after them for the balance to, to pay it. Yeah. Good point. Good point.
Good point. What is another name for reverse mortgage?
Reverse annuity mortgage. And I believe, like, to add on, I think and this could be in our sheet. I think this is in our sheet somewhere. Like the name for like the FHA reverse mortgage is the HECM, the home equity conversion mortgage. But I think that's coming up. But just in case it's not, I know that's something that we study a lot. So
yes. Do you need to know the qualifying ratios to give someone a reverse mortgage loan?
No, no, you don't. The lender just looks at the equity in the home, and I believe the borrower's just ability.
Yeah. So you don't need to know. Well, as the lender will look at the equity and will be paying the borrower. Okay, okay. So it might be like a little typo here.
Yeah.
It looks at the equity. And they'll be paying the borrower, right?
Yeah, I mean, essentially, like, I think there's just a typo there. The bottom line is, like, they don't have to, like, the lender doesn't look at their, like, their qualifying DTI ratios and all of that like you would normally to qualify a loan. They're just looking at the equity that they have in the loan.
Right.
Or in the home, rather.
Right. What is the 2020 maximum loan limit for a reverse mortgage?
It's $726,525.
Yes. What is the 2021 maximum loan limit for a reverse mortgage?
$822,375.
How old do you have to be to get a reverse mortgage?
62.
What is a FHA? Oh, here it is. What is FHA's reverse mortgage called? What was that again?
Is the HECM. Sorry, I got ahead of myself. It's the home equity conversion mortgage, which we call a HECM.
Yes. What two disclosures are required for a reverse mortgage?
So that's the GFE, and which is the good faith estimate, and then the HUD, not the LE and CD. So the LEC and CD is what we use for like primary purchases, but for the reverse mortgage, we the two disclosures are the GFE and the HUD.
In a reverse mortgage, what happens to the balance and equity?
So the equity decreases and the loan balance increases because they're being paid.
Because it's rising debt, right, and then falling equity, right?
Exactly.
Right.
Exactly.
What is the tenure method of payment what is the tenure method of payment for reverse mortgages?
So it's like, so the borrowers are getting paid a monthly check versus making a monthly payment.
Mhm. What are the income requirements for reverse mortgages? Trick question.
So there are no requirements, like they just have to, the borrower has to prove prove that they can pay for the taxes and insurance.
Yeah, no, okay, right. Has to prove they can pay for the upkeep of the property, right? The tax and the insurance, right? That's right.
Yes,
Right.
yes.
Um, and I wonder if it's also like just like maintenance stuff too, right? Maybe like
Yeah, because I know like part of it, like they say, like in addition, like we just said, the taxes and insurance, but I mean, and the upkeep, because like one of the ways that they can um that it can be taken away, if you will, I don't know the correct terminology, but is if they don't take care of the property.
right,
So,
exactly.
basic maintenance, that type of
Yeah,
thing.
you got to cut the grass, right? Because
Right.
if you don't cut the grass, you can the government can assess certain penalties on the property or whatever, right? So yeah, yeah.
Yes.
All right. What are the factors that determine qualification regarding reverse mortgage? Now here's a hint. The VIA, right? VIA.
Oh, yes, yes, yes.
Samara?
So
I haven't seen this on the cheat sheet. So this must be from Samara, huh?
yes, this was from one of the documents that Samara shared with us in the study group. Thank you, Samara.
Yeah.
So VIA, you guys, is the acronym to remember. Remember this. So V is for value of the property. I is the expected interest on the loan, and then A is the age of the youngest borrower,
Mm-hmm. What
which
must
is
happen?
62.
Okay.
Sorry, go ahead.
Me too. Right. Very good. Good point. Yeah. What must happen in order for the borrower to understand the reverse mortgage program? Mm.
So they just need to speak to a HUD counselor to make sure that they are clear on the ins and outs and understand the program.
Mm-hmm. When does a reverse mortgage balance become due?
So um, if the borrower's in default, if let's see, like if the youngest borrower passes away, and then if they, oh, what was it? They're not paying, if they don't pay, well, I guess if you don't pay for your the taxes and interest and all that, then you are in default. So, oh, if you sell the home and then if you're not living there for 12, 12 months or more, and I believe that's, you have to live there 12 consecutive months.
Okay.
That was something I remember Rocky pointed out in the group, that it's like 12 consecutive months.
Okay. Awesome. All right. When can a conforming loan be sold on the secondary market?
Just when they meet Fannie Mae and Freddie Mac's minimum standards, they can then be sold.
What are examples of non-conforming loans and can they be sold on the secondary market?
So that's like the Alt A, which is we talked about earlier, where there's you don't have like it lacks like documentation, like income, asset, that type of documentation. And then so Alt A, subprime, and jumbo, so they cannot be sold on the secondary market.
What is a graduated payment mortgage, a GPM?
Okay, so this was one that came up that I did not know the other night as well, and somebody helped me in the study group. So the payments start low, okay, and then they increase over time. So it will cause negative amortization, but the tip to remember this is, so graduated payment mortgage, GPM, it's used for, like, a good example is for like say doctors or lawyers, like think like when they graduate, they are not making much money right now, but then they eventually are going to make enough, right? So initially they can start off with like a payment that's like, let's just say $1,000, but then the payment over time is going to gradually increase, like as you know they're making more money. So that really helped me remember it.
Yes. And you know, and the payment starts off so low that it's negative amortization in the beginning, right?
Exactly.
Okay. And the reason why is negative amortization is because the payment is so low that it's not even covering the accrued interest, right? So that
Yes, that's what you taught me earlier.
right. So that that remaining interest that's not paid has to be added to the balance, and which is how, you know, negative amortization comes about, right? Okay.
Exactly.
Good. What is a variable balance mortgage?
So this is let's see, I think where this is one I got stuck on the other night as well, where the interest adjust, and I think it can adjust like up and down, but the payments never change.
That's right.
Is
That's
that right?
That's right.
Okay.
So yeah, adjustable interest rate, but payments don't change. Right. Right. All right. What is seller financing?
I mean, it pretty much is like what it says is when the seller gives money to someone to buy their property, I
Right.
guess.
The seller extends credit to the buyer to buy property. Right. Right. Yeah. You know, so the seller is like giving the financing, right, to enable the buyer to buy from the seller, right? Yeah.
Yes.
What is a wraparound mortgage?
So that's when the seller finances enough money to cover, I think, to cover the balance.
Right. Yeah.
Wait, I'm getting confused.
And what else?
Um,
So, all right. So here it is. So seller financing a loan. Okay. So that the seller finances enough money to cover the loan balance and whatever money the borrower needs.
okay.
Right.
Okay.
Because the borrower is going to need more than just, you know, the financing of the loan, right?
Sure.
Right.
Okay.
So I'm
So
thinking
to cover the balance and whatever else
whatever.
they need.
Yeah.
Okay.
What is a growing equity mortgage? A GEM, growing equity mortgage.
So this one is set up like like a regular 30-year conventional. And then so growing equity. So is it where like so is it a fixed rate?
Yeah, it is a fixed rate and it's based on the 30-year. But tell me about the payments though, right? It's a growing equity mortgage. So what's happening?
Oh, okay. So the payments, they hence growing, the payments increase over time. And so if you're making more payment, like a higher payment, then your equity is growing, right?
Right. Now here's the thing though. Like in a regular situation, right? Your equity is also growing, right? In a regular situation. Because remember how we talked about
Sure.
when it's being amortized, more of the payment is going towards paying off the principal. But here's the thing,
Yes.
with this situation of the growing equity mortgage, you're now in a regular situation, you're paying the same payment every month, right? Or whatever, you know, every period, right? You're paying the same every period, but it's just naturally because of the amortization, you are paying down more and more of the principal, right? But here's the thing, with the growing equity mortgage, they purposely make it so that you're actually paying more of a payment each month. So then therefore you are paying off the mortgage even faster. You know what I'm saying? So meaning you are increasing your equity even faster than if you were just to go a regular, way of doing it, right?
Yes, yes.
Okay. So fixed rate mortgage set up like a 30-year conventional with payments. Okay, but yeah, but the payments are increasing regularly. So it has a fixed interest rate. It's fixed interest rate, so the loan balance is paid off more quickly. Right. Okay.
So you're just making higher payments.
Yeah, you're bigger high
So
payments. Right. Right.
yeah.
So all right. What is a teaser rate for an arm?
So that's like a rate that, I mean, pretty much like in the in the word like teaser, like it kind of like brings you in. So it's like a very temporary, like low rate, but it it doesn't last. It's not what's gonna ultimately be at the
Yes.
later
You
on
know,
at the end.
hmm Now, I want to go back to this whole thing because I think some people get confused between the graduated payment mortgage and the growing equity mortgage, right?
Okay.
So you see the difference. So how would you explain the difference between those two?
So the with the graduated payment, because that's the one that you are going to have negative amortization because you're not paying off. I mean, you're paying like a very, very low amount initially,
Right.
but you it catches up because you end up making the payments are increasing, so it will like catch up.
Right.
But then so okay, I see why to make the comparison, because then essentially like the growing equity, um your payments, the payments, the only thing with that, there it's like regular payments and then they just keep increasing. It's not like the graduated payments are very, very low,
Right.
causing negative amortization.
Right.
Like with the growing equity, you're
Right.
not like it's amortizing like a regular 30-year fixed rate loan. It just is starting off like with regular payments and then you're making higher payments.
Yes. Very
So
good.
I mean, I think that's the
Good point. Yeah, yeah. So I guess the main distinction is that with the graduated payment mortgage, you have negative amp, and then it has to kind of recover. You know what I'm saying? Down the line.
yes,
But with
yes.
going equity mortgage, you're not starting at a low amount. You know what I'm saying? There's no negative amp. It's just that it's set up for you to pay off the mortgage quickly. You know?
Exactly.
Yeah.
Yes.
Okay.
Yes.
All right, cool. All right, so now what is the floor for an arm? What's the floor?
So the floor is the lowest, that's the lowest interest rate that um that there will be on the loan.
Right. The lowest interest rate an arm may adjust to, right? Yeah. Yeah. What is payment shock? Right? We talked about it before. What is that?
Yeah, like uh that's like when like the payment increases like drastically, hence like causing payment shock to the borrower. That's why like we have that's why they have caps, so that it will cap out and it can only go so high so it doesn't cause payment shock.
Mhm. What is a convertible arm?
So this okay, so this one allows the borrower to convert from an arm to a fixed rate loan um just one time.
Mm-hmm.
I like one time during the entire loan.
What is a hybrid mortgage? Like, for example, a 5/25.
Okay, so this is like it's a it's a combination of a fixed rate and adjustable mortgage. So if it's a 525, for like the fixed part would be the 5. So for the first 5 years, it would be one specific rate. And then for
For the first 5.
no, did I say is it
You're good. You said you're
okay?
one. Okay, go ahead. Go ahead. Okay, go ahead. Say it again.
So I mean, that's what I think. It like for the first 5 years, it's like stays the same, so
Right.
it's fixed, it's a fixed rate. And then if it's a 525, then it will adjust annually for the next 25 years. So, I mean, if you look at the 5 and 25, if you add those together, that's a 30-year conventional or 30-year loan. So first 5 years is fixed, then it adjusts annually for the next 25.
How old can credit documents be on the dates the note is signed?
120 days. And then for that, I know it's simple, but I just want to point out that for testing purposes, like remember like all the different, I mean, it could be 4 months because that's equal to 120 days. Like just don't let them trick you on that.
What does FICO score stand for, and what is the range of possible scores?
So FICO is Fair Isaac Corporation, and the range is 300 to 850.
What is permanent financing takeout?
So that's like when, like if you are building a home, you get a construction loan. When it's finished, when it's complete, then you take that and you just wrap it into like a permanent financing, one loan, I believe. Yeah.
Right. Once construction is complete, the loan is replaced by a fully amortizing one.
Yeah.
What is equitable right of redemption?
So the equitable right of redemption, this is like when you're like going through like foreclosure. So this will allow you to prevent like foreclosure. It allows you to the borrower to go in and pay off or pay the I guess the amount that's in that's owed.
In default, right? That's right.
Yeah.
Allows the borrower, the mortgagor, in default to pay the entire balance of to avoid foreclosure.
Yes.
What is a prepayment penalty clause?
This is where like the borrower would receive or would have to pay a fee for paying off the loan early.
What is an open end clause?
So this one allows like you to get like receive future advances or payments from a loan. And I think like so an open-ended, like I think that's like a HELOC, like a home equity line of credit.
So allows future advances from the same loan. Right.
Yes.
The government requires financial institutions to file SAR reports within how many days of detecting suspicious activity if the perpetrator cannot be identified?
Okay, so if they cannot be identified is 60 days, and if they can be is 30 days.
Yes. What act requires mortgage applicants to provide their name, address, social security number, EIN, and a government photo ID?
That's the U.S. Patriots Act.
Do conforming loans typically have prepayment penalties? That's a tricky, right?
Yeah, I'm trying. So I'm not sure, Lance. I mean, I want to say no, but I don't know the reasoning.
Okay. So the question is, do conforming loans typically have prepayment penalties? So typically they don't, right? However, if there is one, it has to be disclosed on the notes, the LE and the CD.
Okay.
Right.
Okay.
No,
got it.
LE and CD. Right. Okay, so where do you find the prepayment penalty clause?
On the LE and the CD?
And the notes, right.
Okay, in the note.
Right.
Okay.
The LE, the CD, and the notes. And under loan term table. Okay. So, all right. Now, under federal law, are prepayment penalties allowed on a fixed rate QM, meaning qualified mortgage?
So Yes, but just for the first 3 years.
That's right, just for the first 3 years. Yes, yes, yes. Now, do you remember on Jen's cheat sheet the QM like acronym or the QM? Yeah, it is like an acronym. Jen has a cool acronym for that. But you know what?
For
Like for a qualified mortgage, right?
um
It might not be on the updated one. You know what? I'm thinking that I didn't see it on the updated one actually.
yeah, I'm not sure. Like I'm sure once you say it,
Yeah.
yeah, go ahead. Go ahead.
Well, I mean, no, I'm trying to pull it from my memory too, and I didn't put it on this board. But it's something about like what are the characteristics of a qualified mortgage, right?
Oh yeah, I don't remember that one.
You know, okay, yeah, that's weird. That okay, but anyway,
Yeah, I'll have to ask her to take a look at those sheets.
So FHA requires how many months of ownership before resale?
So you have to own it for 90 days.
Mhm. What is a reconveyance deed?
So I mean, I guess like once you pay off, the loan, you reconvey it
Hmm.
to, I guess, whomever you're selling it to. I don't know.
Right, that's right. And when you reconvey it, right, so you basically are doing what? You're transferring a title.
Oh, yeah, the title.
In the title, right?
Okay.
For the property.
Yeah.
Right. I mean, you're transferring the title of the property, right?
Right.
What is a prepayment privilege clause?
So this is like I guess the opposite of prepayment penalty. Like if you have a prepayment privilege, this allows you to pay off the loan early without being, I guess, assessed a fee.
Yeah, without a penalty. Right, that's right. Right. What is an open-end clause? Oh, this is another. Okay, just to reinforce from before. What's an open?
Yeah, so that's like what we were saying about when it's allows for like future payments to
Mhm,
advances
mhm. What is a
from the same, sorry, from the same loan.
from same loan, right?
Yeah.
What is a blanket mortgage?
So this one, like I think about like when you have like a builder like going into like like a subdivision, they're building multiple like tracts, multiple tracts of land, or it covers multiple tracts of land. And then I think there's like there's another term about where it allows, because it allows you to sell off each parcel like one, one
Yeah,
by one.
that's right. Okay, that'll probably be coming up soon. Right, right. Who is an assigner?
So that's the person, the signor is the one transferring the rights of the loan.
So the assigner is the party who is transferring contractual rights to another. They can sell the loan with servicing retained, or it can sell the servicing rights with the mortgage and notes.
Okay.
All right. Who is an assignee?
So that's the person who's receiving the contractual rights.
Nice. That's right. That's right. Yeah. So, for example, a signor is giving the title to the assignee, right?
Yes, yes.
Who is a grantor?
So this one, I remember this like from your previous video with Kaylee. The grantor, she said like owner, like owner of the property.
Right.
I mean, I know like owner is spelled OWNER, but like if you
Right.
just grantor, owner, like that's how I remember it.
Yeah, that's good. Yeah, it's
Mhm.
the owner of a property who will grant the title to the grantee. So then, therefore, who is the grantee?
That's the person receiving the title.
Right. That's right. What is a deed?
A deed is a written instrument used to convey title or transfer ownership.
Hmm. Let's see. Yes. And then what is a deed restriction?
This is like, I don't, it's like placed on property, so it restricts like certain, I don't know, maybe use of the land. I need to brush up on this one.
So maybe so a deed restriction may be placed in the deed and control the use of the property and run with the land and can't be discriminatory. So yeah, it can't be discriminatory. A restrictive covenant, right? Like limits the future use of the property, right? So a deed restriction. So
Okay.
you're selling it. I mean, so it could be just kind of add some control over the future use of the property, right?
Okay, got it. Thank you.
Yeah. Who is a mortgagor?
The owner, the borrower.
Or the owner, the borrower, the debtor, right? Yeah.
Hmm.
Now, who is the mortgagee then?
The lender.
Right, the lender or the creditor, right?
Hmm.
What is sweat equity?
Um, this is like work done by the borrower that adds value,
Mm-hmm.
and then, but I believe there's like no monetary. It adds value, but
Right now, on our document, we talk about how work done by the borrower that has value and must be listed on the appraisal to be eligible. Does that ring a bell?
yes, yes, yes. That's the rest of what I was trying to
Okay.
say. And then,
Okay.
but then, and then it's not like an acceptable
Oh,
source of funds.
yes. Okay, that was the next. Yeah, is sweat equity an acceptable source of funds? Okay, but it's
Yeah,
not an acceptable source of funds. Okay. Okay.
right.
Well, okay. Interesting. Interesting. All right. Let's see. Okay. How can a homeowner stop paying flood insurance?
They have to request a form from FEMA, and I don't remember what it's called.
So the form is called a MAP amendment form
Map amendment. Okay.
from FEMA. All right. What is um what is forced place insurance?
This is like if a borrower stops paying hazard insurance, then the lender can and will like put insurance on their property to cover their interest in the property. Um, and they have to, of course, let the borrower know that they're going to do this. But it's also can be very expensive.
Very good. Yes. If a homeowner stops and fails to keep hazard insurance, the lender can buy and charge to cover their interest in the property. So yeah, the lender can buy it and then charge the homeowner, right? The fee. And it covers the property, but not the borrower's contents inside.
Oh, yes. Good. Yeah. Good point. I'm so glad that you remember that part. Yes.
Right. Is a conventional loan assumable?
No, again, it has a due on sale clause, so conventional loans are not assumable.
What is the upfront funding fee for a USDA loan?
1%.
Does a USDA loan have PMI and a prepayment penalty?
No.
All right, right, that's true. What is a COE?
That's the certificate of eligibility that is given to veterans.
Mm-hmm.
And I don't know if is that the same thing as the 2214 or 41? I don't remember which one.
We need to look into that. But now, but to say, so yes, certificate of eligibility used for what type of loan?
Okay, for a VA loan.
VA loan, right? Okay, good. And so let's see. We have something called amount of entitlement. So I guess certificate of eligibility, I guess it includes like the amount of their entitlement, maybe. Or something. Okay.
Yes, that's correct.
Okay. All right. How much is a VA variable funding fee?
Okay, I will never forget this one because I got it wrong the other night. And so it's 2.3, and Rocky said funding fee 2.3,
Yes,
funding fee
yes, I remember
2.3.
that
So
too.
thank you, Rocky.
Yes, yes. How can a veteran get the funding fee waived?
So they can get it waived if they are disabled, more 10% or more, and then the surviving spouse as well,
Mhm.
and for surviving spouses.
Yes. Now, this might be just a nuance that might not even be necessary, but on the document it says if they're disabled more than 10%. I was just thinking, well, what if it's exactly 10%? Like, is it, so.
Yeah, I'm
Yeah.
that's as I was saying it, I was thinking, because
Okay.
these things are important obviously for the test. I believe it's, if it's 10% or more, that it includes 10%.
Oh, okay.
But we will
Double check. Okay.
yes, like we will check it. If it's something different, we will change that. But I think it's 10% or including 10% and
Yeah.
above.
Okay.
So
All right. Is a VA loan assumable and is there a prepayment penalty?
yes, they're assumable. There's no prepayment penalty, um, and no down payment for a VA loan.
How much of the purchase price is guaranteed on a VA loan?
25%.
What is the upfront MIP on a FHA loan?
That's 1.75%.
How much is insured on a FHA loan?
So the FHA, remember, like they insure, so 100% versus the VA, they guarantee, and that's 25%.
Mm-hmm. Is a FHA loan assumable?
You know, I actually I hate to say this, but I feel like I had read something, like I have here on my sheet that it has a due on sale clause, but I feel like I read something perhaps in Jen's sheet. So I need to actually confirm that they are assumable.
Okay.
Um
Double check.
yeah, I'm sorry, I have to check on
Sure,
that one.
sure. On a FHA loan, if the LTV is greater than 90%. So on an FHA loan, if the LTV, right, the loan to value, right, the loan to value is greater than 90% when the loan starts, how long will the monthly MIP last?
So if the LTV is greater than 90%, it the mortgage insurance will be on for the life of the loan.
If the LTV, and then well, what about if the LTV is 90% or below?
Then it's for 11 years, the first 11 years.
Hmm. What are the four types of involuntary liens?
So a tax lien, a mechanics lien, judgment, I don't remember the last one.
One, it starts with an A.
Oh, attachments.
That's very good. And then just, but by the way, okay, so what's the one example of a voluntary lien that we talk about in the study group?
Mortgage.
Mortgage, right, right. All right. Regarding outstanding debt, how much will the lender use of the outstanding balance on a student loan for conventional and FHA?
Okay, yes, this is so for conventional is 1%, and then FHA is, a lender will use 0.5% of the outstanding balance.
Mhm. What are reasons a reverse mortgage? Okay, so just as a review, as reinforcement, what are reasons a reverse mortgage comes due?
Okay, yes. So to reiterate what we were saying earlier, the borrower passes away, or they sell the home. They do not live in the home for 12 consecutive months. They default on their taxes when the last surviving borrower dies. And then I believe this is one, I'm not sure if I had mentioned it in the previous answer, but the owner lets the home deteriorate. Oh yeah, because we were talking about if we don't take care of the home. So if you let the home deteriorate, I can't say that word, deteriorate, then it would come due. So there's what, 6 reasons there.
What is a quarterly report of the condition of the business that an entity submits through the NMLS? What are the 2 parts of it, right? Yeah.
So this is one I need to work on. I know like one is like, so there's like the state level.
Right. Well, first, it's called what though? Like what?
Oh, the mortgage call report. So MCR.
Right. Very good. All right. And then 2 parts.
So there's like it's like the state level is like the residential loan activity report. And this is where I get the date, like the time of year. So I think this one is due, is it quarterly?
Right. It's completed quarterly, but it's due when? And it's due within 45 days.
Oh, 45 days of
the end
prior to the calendar quarter.
Well, okay, within 45 days of the end of the calendar quarter, right? But you know what? I remember this was kind of confusing. So 45 day, so like after or 45 days before the end, so
of the end of the calendar quarter.
Yeah, maybe that's something we have to check on.
Yeah, 45 within 45 days of the end of the calendar quarter. So I mean, I guess like a quarter, so every 3 months. So if we're like January, February, March, so if you take March, there's 31 days in March. So maybe 45 days prior to the end of that.
You're kind of, yeah.
I don't know.
It might be something kind of like our NMLS license where we have to do our continuing education, like for the end of the year, like, between November and December 31st or whatever. But I don't know. The way it's written, I'm thinking that it's like within 45 days. So like 45 days before the end of but I don't know. We'll double check. So that's the state level. What about the entity level, right? Like what's that called?
That's I know it's like 90 days before the fiscal year ends. Can you tell me the name?
Financial condition report.
Financial condition report.
Right. And as you say, completed annually within 90 days of the company's physical year end. So on that one too, I guess it's like 90 days before the end of the physical year.
Yeah, so that's like, again, I would think like 90 days prior to, well, I guess if the fiscal year ends December. Yeah, we need clarification of this.
Yeah.
I'll talk to Rocky and Jen.
Yeah. All right, now alimony, child support, retirement, and pension income must continue for how many years beyond application date to be used as income?
For 3 years for it to be used as income.
What is the 4506-C? And it was formerly the 4506-T.
So that's the transcript. Is it authorization?
The request for transcript of tax return.
Okay. So
right.
4506.
It's separate, right? Okay.
Wait, what was that again, Lance?
I was going to say the tax information authorization. That's a separate form.
Yes. So those are like the 2 that I get confused, but I do. So the transcript is the 4506. That's C. It used to be T. But as of 2021, this year, it's 4506C. So that's the transcript request for tax,
Yeah, request for transcript of tax return.
request for transcript of tax return. Okay, got it.
Now, what is the IRS 8821 form, right?
So now that's the tax information authorization.
Yeah. Now, the underwriter will consider what percent of rental income collected.
75%.
Right, right. And when you say considered, meaning what? It's going to consider it as part of what? Their
Their income,
income,
right?
right. 75% of the rental
Yes.
income. Right, right. Now, discount points are used to lower the interest rate. Each discount point will lower the interest rate by how much?
And by 0.25%.
Yes. What is a loan that has an adjustable interest rate that has payments that will never change?
So adjustable interest rate and the payments don't change. That's the variable balance mortgage.
Yes. What act says the mortgage broker can't choose the appraiser on a loan?
That's the Dodd-Frank Act.
What's SFHA stand for?
Special flood hazard area.
Mm-hmm. And let's see, when there's a 1% chance of the area being inundated by water, right? That's what
Right.
we'll classify, right? Okay, so,
Yes.
all right. When two or more parties buy the same or different, so when two or more parties buy at the same or different times, and when their shares can be willed, what's that called?
Okay, so when it's either they buy at the same or different times and they can be willed as tenants in common.
Mhm. What is MARI? MARI.
So that's Mortgage Assets Research Institute.
Mm-hmm. Yes, and it's something you can subscribe to. So it's a collection of people who have committed fraud. I guess it's a database of
Yes,
people
yes.
who committed fraud. All right. What are the reasons? Okay, wait a minute. Okay, no, let me. Okay,
Yeah, we
this
can.
right. This requires. Let's see. Okay, so what about this? This requires lenders to file a report regarding all loans made during the year. It's designed to help meet the housing needs of the community. It's due every March.
And that's the HMDA report. So the Home Mortgage Disclosure Act, correct?
Mm-hmm. Let's see. They compile. Okay, so let's see. They compile information as individual disclosure statements for each institution and in the form of aggregate reports for all covered institutions.
Yes. Okay. This question comes up all the time, you guys. So it's I feel like it's wordy and
Right.
but it's I believe FFIEC, the Federal Financial Institution Examination. Is it council or counselor?
Counselor.
Counselor. Okay.
Counselor.
So Federal Financial Institution Examination Counselor.
Okay.
Yeah.
Awesome. Now, you sure it's counselor? I'm just thinking that counsel could be, or do you think that it could also be counsel? Or do you think that this is something that you had checked?
This was one that I had got from Rocky from the study group, so I would have written it down verbatim.
Okay, good.
Like,
just making sure. Okay.
So if it's wrong,
right. That's right. All right. What are the 5 banking regulators?
So the CFPB, FDIC, and the National Credit Union. Is it institution or administration?
Administration.
National Credit Union Administration. the Comptroller of Currency, and the Federal Reserve Board.
When you pledge property as collateral for a loan while maintaining possession of it, what's that called?
So when you pledge property as collateral,
Starts with an H.
What's the second letter?
Hype.
Oh, is it like the hypothecate or
something like that, right? I don't
something like
forget how to actually pronounce it. And it's not on our document actually, but
that is one actually it's like it comes up a lot in the study group, and that's one I actually need to remember, so it's a good chance of being on the test. So can you say it one more time, like when you pledge?
It's something like hypothecation, but it's when you pledge property as collateral for a loan while maintaining possession of it.
You pledge property for collateral as a loan.
Right.
Okay. Yeah.
It's like a mortgage, right? I mean, it's like the home.
Exactly.
Right?
Exactly.
You're living in the home, but yet it's pledged as collateral, right?
Yes.
So, all right. Which act requires mortgage applicants to provide their name, address, social security number, EIN, and a valid government issue photo ID, just as reinforcement?
The U.S. Patriots Act.
Yes, yes. All right. Flood insurance must be purchased from whom?
From National Flood Insurance Program, NFIP.
What's the minimum and maximum amount of flood insurance needed?
The minimum is 100,000 and the maximum is 250,000.
What's the penalty for violating ECOA?
$10,000.
What's the 4 elements of a valid contract?
So competent parties, legal object, mutual agreement, consideration.
And what's the way that Jen taught us on how to remember that?
Yeah, well, I just said it not the way that she taught. So yeah. It's like competent parties. Oh goodness, competent parties are considering a mutual agreement for a legal object. Is that right? Oh, because competent parties are considering, that's the consideration, right? A mutual agreement for a legal object.
Awesome, yes. What is the front end and back end ratios for conventional loans?
The front end for conventional is 28 and the back end is 36.
What is the front end and back end ratios for USDA loans?
29 and 41.
What is the front end and back end ratios for VA loans?
So the VA doesn't have a front end, but they have a back end of 41.
What is the front end and back end ratios for FHA loans?
31 front end and back end is 43.
An applicant can request a statement of reasons within how many days of receiving the original adverse notice?
60 days.
If an application for credit is denied based on the appraisal, the borrower has how many days to request a copy and the lender has how many days to deliver it?
So 90 days to request a copy and the lender has 30 days to deliver it.
ECOA deals primarily with what?
Credit applications.
What is included in the APR?
So like for me, because there's so much that's included in the APR, it's like everything that's related to the mortgage.
Right.
So if you look at it that way, like things that are actually related to the mortgage.
Right. Very good. So then therefore, if you get a question that says, okay, what's not included in the APR, you just do the opposite. You just think, okay, what are some stuff that's not included, or what are some stuff that's not related to the actual mortgage, right?
Yes. So I think so it's much like easier, like this is like shout out to Jen. So like she taught us to use TENACTS, TENACTS. So this is everything that's not included. So if you know everything that's not included, then everything else you know is included. So TENACTS, the T is so title, the title insurance, escrow fee or escrow notary fee, the appraisal, credit report, termite inspection, and seller credits.
Yes. When do you give the servicing transfer statements, and how many days does the borrower have to get the payment to the right place?
So you give it 15 days prior to transfer, and then there's a 60-day grace period.
Fannie Mae requires only a blank year history to be reviewed for all credit and public information.
7 years.
What's the minimum down payment for a FHA loan?
3.5% if your credit score is 580 and above.
And if not, if it's what's the other thing?
So if it's like between 500 and I guess in 579, not I guess, between
Right.
500 and 579, then you just have to put 10% down. And if it's 500, if it's below 500 rather, then you don't qualify.
Right. At what credit score is a borrower not eligible for, okay, wait. At what credit score is the borrower not eligible for a FHA loan? Right.
So if it's below 500, so not to confuse, so it has to be like basically 499, because if you're 500 to 579, then you can qualify with 10% down.
Right.
And then 580 and above, it's 3.5% down.
Right. Let's see. What's the late fee for VA loan?
The late fee for VA is 4%.
What's the late fee for FHA loans?
4%.
That's right. What's the late fee for USDA loans?
4%.
What's an easy way to remember that, right? So all government loans, right?
Exactly. So all government 4%, and then conventional. So 444, and then conventional is the 5.
Excellent. Yes. How many months of PITI payments must be verified for a loan on a non-owner occupied property?
6 months.
How many months of PITI payments must be verified for a loan on an owner occupied property?
2 months.
What percentage of ownership do you need to be self-employed?
25%.
If the credit report does not show a required minimum payment amount, the lender should use an amount equal to what percent of the outstanding balance?
5%.
Commission, overtime bonus, and part-time income must be averaged over how many years?
For 2 years.
Consumer debts that have less than how many months of payment remaining do not need to be included for the purpose of calculating debt ratios?
10 months.
What is a 203B loan?
That's the basic fixed rate loan.
Right. What is a 203K loan?
So that's the rehab loan. And this is in another way that how I remember this is from Kayla. When you think the K, you think about thousands of dollars. It costs thousands of dollars to rehab a home. So 203K rehab.
What is a 203G loan?
That's like the special loan, like you think of like Good Neighbor, like for like teachers and firemen, police officers.
What are 2 types of freehold estates?
Fee simple and life estate. And just remember, like fee simple is like, that's the best.
If a consumer requests cancellation of their escrow account, the lender must deliver an escrow closing notice no later than how many days before closure of the account?
So 3 business days before the account's closed.
Mhm. And that's only when, if a consumer requests cancellation of their escrow account, right? So it's 3 business days in that scenario.
Mhm.
But what about if it is closed for any other reason?
Then it's 30 business days.
30 business days before, right? The escrow account is closed, right?
Yes.
Very good. Now let's talk about document retention. All right, how long do you have to retain TILA disclosures?
So TILA is 2 years.
Okay, what about DNC, the do not
Two
call list?
2 years.
Right, what about MAP, the mortgage acts and practices?
2 years.
All right. What about how long? What about the LE, the loan estimate?
3 years.
What about the LAR, the loan application registry?
3 years.
What about the LOC, the loan officer compensation? Or
3 years.
loan officer compensation or loan originator compensation?
I think it's, oh wait, no, it's loan.
Originator?
I think it's I think it is
It
loan
might be originator. It sounds like it'd be originator. Okay.
loan officer. No, yeah, that doesn't
Yeah, your loan originator. Okay. Well, anyway,
well, the LOC.
compensation. It's compensation for the loan originator or loan officer, right?
Yeah, I think it's a loan because there's a the loan origination compensation rule, right?
Okay. Okay. Yeah.
So
Right,
so that's LOC. So
right, so that's okay. So you said that was how many years was that?
3 years. So just like a good trick that has always stuck in my head that I've got from all of you guys is that for the LE, the LAR, and the LOC, they're all 3 years. So there's 3 of them. They start with L, and there are 3 years.
Very good. Very good. That's good. And then how long do you have to retain the CD, the closing
So
disclosure?
5 years.
How long do you have to retain the SAR, the suspicious activity report?
For 5 years.
How long do you have to retain ECOA, the Equal Credit Opportunity Act disclosure?
So that's for 25 months. That's the only thing that's 25 months. And just remember, because you can actually sue for up to 24 months. So
very good. So let's explain then how you keep it all together in terms of document retention. You mentioned the ones that were like 3 years. So basically, I mean, we got so that's 5 years, 3 years, 2 years, and then there's 25 months. So as an overview, how do you keep that all together?
So I basically look at again, like ECOA, that's the only thing that's 25 months. And then I think about, so the next one, like for the 5 years, like the closing disclosure. So I just think about what it actually is. I mean, it's important. It has all the numbers that pertains to your loan. So, I mean, that's something that's serious. You'd want to keep the longest. And then the suspicious activity report, I just group those two because I just think about it's something that is more serious. I mean, I guess I don't want to say versus not serious, but those two together are the 5 years. And then I think about, like I said, the 3, the LE, the LAR, and the LOC are the 3 years, and then everything else is 2 years. So if you can remember, ECOA is the one thing that's 25 months, the 2 things that are 5 years, CD and SAR, and then if you remember the L's for the 3 years, then the rest is 2 years.
That's good. And just as a review, what are the 3 ones that are the L's?
The LE is the loan estimate. The LAR is the loan application registry, and then the LOC is the loan what do we say? The loan originator compensation, I
Right.
believe.
Excellent. Excellent. And as we're on this, I know sometimes people will ask, okay, how many pages is the CD and how many pages
Oh,
is the LE?
yes, yes, I forgot about that. Yes, so the CD, again, we keep for 5 years, and that's 5 pages. The
Yes.
LE we keep for 3 years, and that's 3 pages. That's like beautiful.
Yes. Yes. What is warehouse funding?
So that's when a lender gets money to, I guess it gets money for a loan, or gets, let me rephrase. That's when a lender gets a line of credit from a commercial bank for a loan, something
Right.
like that.
Very good. Yes, yes. Warehouse funding occurs when a lender obtains funds for closing from a line of credit extended by a commercial bank. Right. Now, what's a trick to remember that when you think warehouse funding? Warehouse. What's the trick?
The think like commercial,
Yeah.
like think like large.
Right, commercial, and then so you're thinking so it should trigger commercial bank and then line of credit from a
Yes,
bank.
yes.
Excellent, excellent. What is an estoppel letter?
And this is when the closing agent sends a letter to the lender to request payoff amount.
Mm-hmm. Wait a minute, wait a minute.
Wait, is it the seller's lender?
Yeah, seller's lender, right.
Okay.
Right. Closing agent sends an estoppel letter to the seller's lender requesting the payoff amount, right? Who maintains flood maps?
FEMA.
What is a deed in lieu of foreclosure?
So this is when like the borrower like voluntarily, I guess, I don't know if you say like gives up or conveys
Days, uh-huh.
the deed um back to the lender, like so that like in exchange or for satisfaction of mortgage, maybe like before they go to like court. It's basically to try to keep the um by doing this they keep it off of their credit, but then the lender doesn't have to accept it. It's up to them.
Right. Very good. Yeah. A deed in lieu of foreclosure occurs when the mortgagor voluntarily conveys the deed to the lender in exchange for satisfaction of the debt. Debtors still lose property, but by conveying it voluntarily before final court action, they avoid foreclosure on credit record. Lender is not obligated to accept.
Okay. Okay.
Yeah. Now, what are the 4 types of legal descriptions for properties?
So the government land survey, monument, lot and block, and meets and bound.
Mm-hmm. What is a CTR and who does it go to?
The oh, you know what? Actually, real quick, Lance, I want to point out on the legal descriptions of properties that the lot and block method is the most common method. And then the meets and bound is the most accurate method. That could be something on our test. So
very good point. Mm-hmm. Mm-hmm. Okay. All right. And then okay, so what is a CTR and who does it go to?
so that's the currency transaction report that goes to the IRS.
Mm-hmm.
And then I think so it's like if they have to send this report to the IRS if there are transactions that are over 10,000 per day.
Mm-hmm. Mm-hmm. That's right. So, all right, awesome. Awesome. Yeah, currency transaction report, and it goes to the IRS. Right. That's right. Now, just let's see. The Bank Secrecy Act (BSA) and the Anti-Money Laundry, right (AML) laws require companies to file a currency transaction report with the IRS for cash transactions exceeding 10,000 in one day. The act requires financial institutions to keep detailed records of cash transactions exceeding $10,000. So that's like withdrawing, depositing, or transporting. All right, so that's just info there. Now, who is the CTR under?
So they, the CTR is under the BSA, which is the Bank Secrecy Act, and then AML, which is the
Right.
anti-money laundering.
Yes. Now, and who are they under? Who are those two under?
And they're under the U.S. Patriots Act.
Right. A company with which a consumer has an established business relationship, EBR, may call for up to how many months, and what about if the consumer only inquires or submits an application?
So if they have an EBR, they can call for 18 months. And if they've just like submitted application or inquired, then it's 3 months.
Yes. All right. What is the penalty for sending an unauthorized fax?
$500.
Very good. What is Mars?
So Mars is Regulation O, and that's the Mortgage Assistance Relief Services. So that is like, this is the one that's like hard for me to verbalize, but it's basically like when it helps like the borrowers who are in default to like when there's like scams, like foreclosure scams, like I don't know how to say, like
so it'd be foreclosure prevention scams, right?
okay.
Yeah, right.
Can you
Okay.
just
So here it is. So the Mortgage Assistance Relief Services rule helps to protect distressed homeowners from foreclosure prevention scams. It applies to negotiators assisting borrowers with mortgage loan modifications.
okay.
So yeah. So now what does it do though? Like what are some of the aspects of the rule in terms of Mars, right?
So it says like no fees are collected front. No fees can be collected up front without a written agreement. And then it like the negotiator cannot interfere with between the borrower and the lender, and cannot tell the borrower to stop making payments.
Right, exactly. Awesome. Now the lender has how many days after closing to refund the borrower any portion of the charges that exceed the acceptable amount of tolerance levels?
So they have 60 business days. 60 business days.
And what about for non-numerical clerical errors?
That's 60 calendar days.
TILA was implemented by who?
The Federal Reserve Board.
Now, who administers TILA though?
The CFPB.
Right. All right. So it was implemented by the Federal Reserve Board, but it's administered by the CFPB.
Yes.
Here it is. What is loan flipping? That's what we were talking about.
This is like an abusive practice when a loan is refinanced without any net tangible benefit to the borrower, which is a form of equity stripping.
A creditor must respond to a payoff request within how many days?
7 days.
Who took control of Fannie Mae and Freddie Mac in 2008?
So the FHFA, which is the Federal Housing Finance Agency.
Now, who allowed it?
HERA.
What is the appraisal recertification form called?
So that's form 442. And so I think to reiterate what we're saying earlier is like the appraisal lasts for 6 months, but after 4 months, it has to be recertified. And the form is called is 442.
A borrower's payment history on previous mortgages and rents must be verified for how long?
12 months.
Now, what are the 8 protected classes of ECOA? And what's a helpful hint to remember them?
Yes, so this again is from Jen's cheat sheet, score map. So score SCORR, and then map MAP. So so sex, color, national origin, race, religion, marital status, age, and public assistance.
Mhm. Now, you can't ask how many children a borrower has, but what can you ask?
You can ask, well, how many, or do you have any dependents?
Mhm.
I was going to say how many children. I mean,
Right.
don't say that. Do
Right.
you have any dependents?
Right. And you can't ask if they're single. How can you ask though?
You ask, are you married, unmarried, or separated?
Who enforces ECOA?
The CFPB.
What is a defeasance clause?
So this is when I just think, I think I got this from you, Lance, we're thinking like defeat, like defeasance clauses, like when you defeat, like you defeat the loan, so you pay off the loan. So then the lender has 60 days to give like a satisfaction of mortgage. Is that right?
Mm-hmm. That's right. That's right. The
Oh,
mortgage.
like, yeah, it has satisfaction of mortgage notice to the borrower, like after.
That's right. Within 60 days of paying off the loan. Right. Excellent. What is a subordination clause?
So this is where like it has like causes like a senior let's see, like a senior mortgage to, or allows, I would say it's allows a senior mortgage to take a junior position.
Junior lien position, right? So it a mortgage subordination clause permits a senior mortgage to assume a junior lien position. Mm-hmm.
Okay, got it.
What is escalation clause?
So this clause allows the lender to increase the interest rate of the loan, like under certain circumstances.
What are the maximum seller concessions on conventional loans?
Okay, so when the LTV is greater than 90, so 90.1 and up, then the seller concessions are 3%. If the LTV is between 75 up to 90, then it's 6%. And then if it's anything below 75, the LTV is below 75, then it's 75%, then it's 9% seller concessions.
Okay, wait a minute. Let me see. So you said if the LTV is over 90%, then it's 3% seller concessions, right?
Correct. So 90.1 and up. So it has to be, it can't be including 90. So it's 90.1 and up. Okay.
Or another way of saying is if it's over 90, right?
Yes, that's simple.
Okay, right?
Yes.
All right. So over 90 is 3% seller concession. Now, then you said if it's over 75, but up to 90, right?
Correct.
Over 70, so including 90, right? So over 70,
Yes.
so not including 75, but over 75 up to 90, 6%, right?
Yes.
But now here's the part though. Then the last part would be if the LTV is 75% or lower. So meaning including 75%, right?
Exactly.
Okay.
Right.
Good. Okay. Okay. So I want to make sure. Okay. So 75% or lower, not 9%. Okay, good. Now, and then what about investment property?
2%. It's always
2%. Okay, good. Okay, good. All right, cool. All right. Let's see. Now, what are the maximum seller concessions on a FHA loan?
6%.
Mm-hmm. What about maximum seller concessions on a VA loan?
4%.
What about the maximum seller concessions on a USDA loan?
6%.
Right. Excellent. Now, what are the two appraisals for VA loans?
That's NOV and CRV, which is notice of value and certificate of reasonable value.
What is lis pendens?
So this is filed by the lender when the borrower is in default, and it's like it's the foreclosure notice, and it can't be they can't send this notice until the borrower is 120 days in default.
Mm-hmm. And a way to remember that, lis pendens is like Latin, and I forget what exactly it means, like in Latin, like lis pendens. But anyway, just as a like a note, if you look up the Latin origin, it's going to help you trigger to remember that definition, lis pendens.
Okay, good.
The thing is, like
Do
I
that.
think it's like lawsuit pending or something like that, you know. But anyway, all right.
Ooh,
Yeah, right.
that could be like,
That
even if
could
it's not now, I'm gonna definitely remember it.
right. You know, lis pendens. You know. All right. What are three common disbursements plans in a construction mortgage?
So use the acronym for this, VFW. So voucher, fixed, and warrant.
Mhm. What is a deficiency judgment?
So this is like this judgment allows the lender to I think it's like it allows them to sue for like, how do I say this? Allows them to like sue to like collect what they, like if they went into foreclosure and
Mhm.
they didn't sell it for enough money to pay off the loan, then it allows the lender to sue the borrower for, you know, whatever assets to
Right.
to make up for their loss. But
Right. Exactly. So,
maybe let's read that.
in other words, yeah, a deficiency judgment allows the lender to claim other assets from the borrower when the proceeds of the foreclosure sale are insufficient to satisfy the mortgage lien. Right. Right.
Yes, what Lance said.
What is a 5-1 arm?
So a 5/1 arm has a fixed rate for 5 years and then it adjusts annually after.
Mhm. Okay, as a recap, what are the four indices?
So COFI, COSI, LIBOR, and Prime.
Mhm. All right, what is a FHA reverse mortgage called?
That's the HECM Home Equity Conversion Mortgage.
What does the SAFE Act stand for?
So it's Secure and Fair Enforcement for Mortgage Licensing Act. So I just want to point out with this, like sometimes like when I go through test questions, it will like, because it's called the SAFE Act, it will give it one of the answers as safe and fair enforcement. So just don't let it trick you on that. So it's a SAFE Act, but it's Secure and Fair Enforcement for Mortgage Licensing Act.
Who enforces FACRA, the FCRA? And what does FACRA stand for?
The Fair Credit, well, FTC enforces FACRA, and it's the Fair Credit Reporting Act.
Who enforces ECOA, and what does ECOA stand for?
The CFPB, and then Equal Credit Opportunity Act.
Right. And what does CFPB stand for?
Consumer Federal Protection Bureau.
Mm-hmm. And going back to FACRA, you said FACRA is enforced by FTC. What does FTC stand for?
The Federal Trade Commission.
Mm-hmm. Who enforces TILA?
CFPB.
All right. And then who enforces RESPA?
So again, CFPB, just but was previously HUD.
Mm-hmm. Who created DNC?
FCC and FTC And the FTC, like we said, is Federal Trade Commission, and then the FCC is, I believe it's Federal Communication Commission.
Very good. And a way to kind of remember that is, so the DNC is what? What does the DNC stand for?
Do not call.
And so that's related to, like, you know, people calling us to try to sell us something, right? And they're calling us using a telephone to try to sell us something. And so a way to kind of think of it is that, okay, so the telephone is communications. And so that piece is kind of like, it should trigger the FCC, right? Federal Communications Commission.
Yes, that's good.
The fact that they're trying to sell us something should trigger business, like trade. So the FTC would be triggered there. Yeah.
Yes.
Those two. All right. Who implemented TILA?
The Federal Reserve Board.
And what does TILA stand for?
The Truth in Lending Act.
Who implemented HMDA?
Again, the Federal Reserve Board.
What does HMDA stand for?
Home Mortgage Disclosure Act.
Who created the red flag rules?
So the red flag rules, the FTC, and FACTA.
What is the IRS Form 8821?
Tax Information Authorization.
Yes. All right. What is the 4506? Okay, T, and what's the new name for it? What's the new form, right?
So the new name is 4506C, and that's the request for transcript of tax return.
Yes. What is a QWR?
So a QWR is a qualified written request, where it's like if homeowners are not happy with whoever's servicing their loan, then they can like submit like a request to transfer, like, and have like a different servicer. And I believe like once you submit it, they have 5 days to respond to you, and then 30 days to like basically fix the problem. And there's like a 15-day extension if there were like, I think something like errors submitted by the borrower.
Now, when you say is a request, you said that like they can request like a different servicer, you said?
Yes.
Oh, well, yes. I mean, okay, because I've been thinking that, I mean, the request could be like any type of issue. And I guess it could include that, but I'm just thinking like it's more.
Okay.
Yeah.
Yes.
Like
yes.
Some type of issue. Okay. And then like the servicer would be, you know, would be responsible for resolving the issue.
Gotcha. Yes. Yes.
Right? Okay. All right. Good. Cool. All right. What are HCML? Right.
So so high cost mortgage loan is HCML, and that is section 32 of RESPA, I believe. And then so this is like when if the APR exceeds the APOR by 6.5% on the first lien. Is this the one that's 50,000 or more?
Right.
Okay.
First,
so 6.5%. So if the APR exceeds the APOR by 6.5% on the first lien, that's 50,000 or more, and then 8.5% on the first lien of 50,000 or less, and then 8.5% on is it like a subordinate lien?
That's right.
And then to remember, like it has the acronym we use is BAPS, BAPS. So it like you can't have like any balloon payments, it must have the ability to repay, and there's no prepayment penalty.
Mhm.
No prepayment penalty, and you must speak to a HUD counselor.
Okay, right. That's BAPS, right? Okay, very good. Yeah, yeah. Excellent. And then now there was some extra stuff, about a loan will be considered a high cost if the points and fees exceed the following thresholds. Do you remember that? Hearing about that?
Yes, I do, and this is the part that I have to brush up on, that I don't like.
No worries.
I don't remember, like,
And honestly, I don't think it's going to be like as important as the other stuff, right? But it
yeah,
is
like when
good to be aware of it, Yeah.
yeah, like when I'll definitely talk to Rocky, but I don't
Mm,
like when we study, like, this is like what I just shared is all the stuff
right.
that we go over, like,
Exactly.
so
Exactly. So just to make note of it though for the video is that all right. So in addition, a loan will be considered a high cost Section 32 loan if the points and fees exceed the following threshold. So I guess in addition to the other stuff, if it's also this, then like okay, so points and fees exceed the following thresholds: 5% of the loan amount for loans equal to or greater than 21,549, or 8% of the loan amount, or 1077 for loan amounts less than 20,579. But all right. And I even said special note, double check these numbers because the numbers might have changed. So, but anyway,
yes.
so yeah, it gets real complex.
Yes, it does, but again, like, I really think, like, the other stuff that we've shared is the
Right.
mainly what is
That's the main.
repeatedly comes up in the study groups.
Exactly right. Yeah. All right. And now what about HPML?
So, okay, so this is how I remember, like, so high cost mortgage loan, so HC, and then high price, so HPML is high priced mortgage loan. So that, which is section 35 of RESPA, and high cost is section 32. And how I remember it is, like, the C comes before P in the alphabet. So I think, and then number 32 comes before number 35. So that's how I've been able to remember, like, section 32 is high cost, section 35 is high priced, if that helps anybody. And then the high price is when, again, the APR exceeds the APOR by 1.5% on the first lien, and then 2.5% on the, is it,
Jumbo first lien loan.
okay, that's
5%.
so is it 1.5% on the first lien and then 2.5% on the jumbo first lien?
Right.
Okay, and then 3.5%, is it just like subordinate lien?
That's right.
Okay, and then so we then use the acronym APE, so APE, so must have the ability to repay, and then no prepayment penalty unless in the first is it first 3 years?
No, 2 years.
2
Right?
years. Okay. So APE, so ability to repay, no prepayment penalty unless the first 2 years. Oh, and then must or then have escrow for the first 5 years.
That's right. Yes, must have escrow for the first 5 years. Yep. Very good. What is another name for the GLB Act?
That's the Graham Leach Bliley Act. And another name is the Financial Modernization.
Ooh, financial what?
Oh, Services
Yes.
Modernization Act of 1999.
Yes. Under FACRA, right? FCRA, under FACRA, when can you get a free copy of your credit report?
So you can get a free, so if you have there's like a handful of things. So if you have fraud or errors on the report, if you're unemployed, is like public assistance.
If you're receiving.
And then unemployed public assistance. Did I miss one? Oh, identity theft. So if you're a victim of identity theft, inaccurate information, fraud, receiving public assistance, or on unemployment.
Also, one more. If you
adverse action. Sorry.
Right. Yes, very good. TILA applies to credit transactions payable in how many installments?
So more than 4. So I just want to elaborate on that because I got stuck on this. So it's not 4, it's more than 4. So 5 and up.
Yeah. Now, how many pages? Yeah, you had mentioned this before, but let's just review this again. How many pages are there in the closing disclosure, and how many pages are there in the loan estimate, and how do you memorize that?
Okay, sure. So the closing disclosure has 5 pages, and remember that you keep the document retention, you keep it for 5 years. And then the loan estimate has 3 pages, and we keep it for 3 years.
Mm-hmm. What is the penalty for violating the GLB?
So up to 5 years and a fine.
Mm-hmm. And what does the GLB stand for?
Graham Leach Belisle.
Right. Excellent. What is a temporary 2-1 buy down?
Okay, so this allows the borrower to, how does it go? Like it's, so they reduce the interest rate by 2% on the first year, and then 1% the next year, and then it goes back, then nothing like after it goes back to the original rate.
Mm-hmm. What is a suit of quiet title?
It's used to remove like a cloud on title.
Mm-hmm. What is a chain of title?
So this is like just gives like the record of ownership. I think it's like in chronological order from ownership.
Mm-hmm. What is functional obsolescence?
This is like a change in the buyer's taste.
Mm-hmm. What is color of title?
This one is where like it's just sketchy. It's like where it like appears to have like as if they have title, but they actually don't have title. You could probably explain it better, but
color of title is the appearance of having title to personal or real property by some type of evidence, but in reality there is either no title or it's a defective title. This person is usually not the true title owner. Right?
Okay.
All right. What are trust deeds?
They're instruments placing special financial interest entitled to real property into the hands of disinterested third parties as security for payment of the note.
Yes. All right. Borrower is called the trustor, right? Lender is the beneficiary who retains notes and deed of trust, right? Okay. Trustee holds legal title to security property described in the deed of trust, subject to terms of the trust for lender benefits. Okay. Now, mortgages. What type of foreclosure do mortgages have?
So they have judicial foreclosure, so you have to go to court.
Right. And what about trust deeds?
They have non-judicial, so like you don't have to go to court.
Mm-hmm. All right. So what is let's go through these different documents. What is the 1003?
So the 1003 is also called the ERLA, Uniform Residential Loan Application.
What about 1004?
That's the Uniform Residential Appraisal Report.
1005?
The verification of income.
Or what's another name for it?
Or I'm sorry, or employment actually.
Employment, verification of employment, the VOE, right?
Yes, yes.
What about 1006?
Verification of deposit.
1007?
Verification of rent.
1008?
And just real quick, I wanted to say something. I think I got this from you, Lance, where to remember, like I kind of group like the 1003 and 1004 together, and then the 1005, 6, and 7. I think about like, so you verification of employment. So you have to basically work, to get money to be able to then deposit, to be able to then pay rent.
That's right.
So that's how I remember the order of them. So does that make sense?
Yes, absolutely. That's awesome. Awesome.
Okay.
And what about 1008?
Transmittal summary. So that's just like the top page, and it is just going over what's of the loan package.
Yes. And a way to remember it, might be helpful for some people is that 8 is like a number of completion in a way, right? 8,
Yes, very good.
Like transmittal summary. What about 1009?
That's the reverse mortgage.
Yes, reverse mortgage. What about form 442?
That's the recertification of appraisal. Yeah. Again, done at 4 months.
That's right. What are the 5 C's of underwriting?
Okay, so capacity, capital, collateral, character. What am I missing?
One more.
Oh, credit.
Right. There you go. What are the 6 items that make a complete application?
Okay, so again, like this is on Jen's cheat sheet, and we have to all give props. All this is coming from Affinity Mortgage, so thank you. But for Jen's, thank you to Jen for the acronym of aliens, that to remember it. Address, the loan amount, income, estimated value, name, and social security number.
Very good. What is the equitable right of redemption?
So this is like if the borrower is in default and facing foreclosure, this allows them to pay off whatever amount that they're in default to be able to keep the property from being foreclosed.
That's right. What is table funding?
So this is like when it's like the broker can originate the loan in their name, and then immediately after they close it, then they sign it over to the investor.
That's right. So table funding is a process that allows a broker to originate and close a loan under his or her name. After closing, the mortgage and note are immediately assigned to that and to an investor, right? What is a direct investor?
It's when the lender deals directly with the borrower without any going directly to the borrower without any middleman.
Excellent. What is a builder bailout scheme?
So, okay, this is like when a builder is having trouble selling property, so they end up using how do you say
fraudulent.
Yes, fraudulent and fraudulent means to sell the properties, basically, right. to unload the properties.
Unload the properties, right. What is dual tracking?
Okay, so dual tracking, that's a part of RESPA's section 6. is when the borrower is like facing foreclosure, but they're still how is it dual tracking occurs when they're continuing to seek foreclosure actions when the borrower is how do I say is being considered for other workout options.
Yes, yes. What are 3 types of caps on arms?
So initial, periodic, and lifetime. So that wouldn't that be like if you have like we talked about like a I don't know, like a 2, 2, 5, 6 or whatever. The initial is the 2, the periodic is the 5, and 6 is a lifetime.
Very good. What is alienation clause?
This is when if it allows the lender to have or make like the entire balance of that's due right away if the borrower sells the property.
Right. That's right. Yeah, payment if or transfers the loan, right?
Oh yes.
Yeah. So really, okay. So the mortgage alienation clause is a provision in a mortgage enabling a lender to demand full repayment if the borrower transfers the loan.
Yes.
What is exculpatory clause?
So this clause is the one it prevents the lender from requesting a deficiency judgment against the borrower when there's not enough money that was received from the foreclosure to pay off the loan. So like we were talking earlier about the deficiency judgment, which when they have that is when they're trying to get the money that they trying to recoup the money that they didn't get from the foreclosure. This is like preventing them from requesting that type of judgment.
Who created the SAFE Act?
This is HERA, which is the Housing Economic Recovery. Housing Economic Recovery Act.
So Housing and Economic Recovery Act. Of what year?
2008.
Who created the CFPB?
The CFPB was the Dodd-Frank Act and the CFPA.
Yes, that's right. And what does the CFPA stand for?
Consumer Financial Protection Bureau.
Act. Consumer Financial Protection Act.
Oh, I'm sorry.
Right.
Yes, you said what is the CFPA? Okay. Yes.
Right. All right, good. All right. Okay, and what does RESPA cover?
1 to 4 residential property.
All right. When do you give the initial escrow statement?
So it's usually given at settlement, which is also used interchangeably with like consummation or at closing, but the lender has 45 days to deliver it. And this is also referred to as the hello letter.
Yes, excellent. What now who enforces FACRA again?
The FTC, the Federal Trade Commission.
What does TRID not apply to?
So and for this one I think of use the acronym HARM, HARM. So TRID does not apply to HELOCs, all cash sales, reverse mortgages, and mortgages for mobile homes that are not secured by real estate.
Good. What is simultaneous issue?
When you issue the homeowner and the lender's title policy at the same time.
Who is the guarantor?
The owner of the property. Well, I don't know about that one actually.
Yeah, the guarantor is the owner of the property. Right. Guarantor is the owner of the property. Now, what about what is HVCC?
So that's the Home Valuation Code of Conduct, Home Valuation Code of Conduct, which prevents lenders from picking out the appraiser.
Let's see. That's right. So the Home Valuation Code of Conduct, HVCC, prevents a mortgage broker from choosing the appraiser for loans that are sold to Fannie Mae. Right, but then the Dodd-Frank Act extended the law to include all mortgages. So
yes,
so it prevents more, so it prevents the mortgage broker from choosing the appraisal for loans, right, for all loans.
exactly.
Okay.
Yes.
Good.
Yeah.
All right, cool. So now here's the thing. So to recap, I mean, just to emphasize certain key points. We have the, can you see this clearly? You can't really see it clearly, can you? It's there, but you can really see the numbers, right? Not really.
No, I can't see anything on my end.
Oh, you can't. Oh, okay, I got you. Okay, all right, no worries. So, all right, conventional. What's the what are the ratios regarding conventional?
So conventional is 31-43.
Whoa, conventional.
Oh, 28-36. Sorry.
Right, okay. USDA.
29-41.
VA.
Nothing on the front end and 41 on the back end.
FHA.
31-43.
Down payment regarding conventional.
That is it the 3% or 5%, like contingent? Right. Okay.
That's right. And it's 3% for who?
Like if you have if you've bought a home like in the past 3 years, but if you haven't bought a home in 3 years or more, then no, I'm sorry. Isn't it like 3%? You have to put
the minimum. Okay, so what we're saying here is the minimum payment for a conventional loan is 3% if the borrower is a first time.
Oh yeah, if they're a first time homeowner.
Right, which means, and when you said your definition was clarifying what a first time home buyer is, right?
Yes, exactly. So if they have not purchased a home in 3 years.
Well, okay. Oh, whoa, wait. No. It's. I mean, to really clarify is that they can't have not. They must not have owned a home within the past 3 years. Meaning they were not on a title of a home.
Oh, okay. That's
suppose a person bought a home, like suppose they purchased the home 20 years ago, but then they still are on the title, right? Then they wouldn't qualify for first time.
Oh, okay. Right. Okay.
So all right. So first time home buyer, all right, it's 3% the minimum. But if they're not a first time home buyer, what's the minimum?
5%.
Right, awesome. What about down payment minimum regarding USDA? Trick question.
Oh, there's no down payment.
No down payment, right. What about VA?
No down payment.
No down payment. What about FHA?
3.5%.
If, right, because it's 10%.
Oh, 3.5% if they have if their score is above 580.
Right, if their credit score, right, their credit score is above 580, right. And then if it's not, well, what's the situation?
So if it's if their credit score is between 500 and 579, then they have to put 10% down.
Wait a minute now. Wait, is it okay? So it just goes back to the whole thing about the 580. Well, which one is the 5? What if it's exactly 580?
If it's exactly 580, then it's the 3.5%. And if it's 500, if their score is between 500 and 579, then it's 10%.
Okay. All right. Now, are you sure about the 580? Like, is 3.5% if it's above 580 or 580 and above? Like, just want to.
Okay, the three, so three, let me see, the three, so 3.5%. Oh, okay, for yeah, for 580 and above, and then the 10% is the yeah, I'm positive. So 500 to 579 is 10% down, and then 580, so including 580 and above is 3.5%.
Okay, good. Okay, all right, cool. All right, now what about explain the seller concessions regarding conventional loans?
Okay, so the seller concessions are if the LTV, which is the loan to value, is greater than 90%, meaning 90.1 and then the seller concession is 3%. If the LTV is between 75 to and including 90% then it's 6% concession. And then if it's anything below 74, so not including 75, below 74, then it's 9%.
Wait. Well, you should say below 75, right?
Below 75, sorry. Sorry.
Good. Uh-huh. Okay, so say it again. Below 75 is what?
Yes, so if the LTV is below 75, then it's 9% seller concessions.
Very good. And if it's investment property?
Then it's 2%.
Very good. Now, what about seller concessions regarding USDA?
Ooh. Goodness. Wait, I don't know, Lance, actually.
Don't worry, it is 6%.
Oh, okay, 6%, and then also, oh, that's right, 6%, and then also FHA is 6%, right?
Right. 6%.
And then VA is 4%.
Right, yeah. And then, by the way, just to clarify, we're talking about these are the maximum seller concessions, right? Okay.
Correct. Yes.
What about late fees for a conventional loan? What's the late fee?
That's 5%.
And it's 5% of what?
Of the loan amount.
Yeah, meaning no. I mean, well, remember, this only applies.
Of just the principal and interest. They can't charge it on the taxes and insurance.
Right. Very good. What about for USDA and VA and FHA?
They're all 4%.
Very good. Now, the high price mortgage loans, right? Just to recap that in terms of like how you remember it, right? Well, number one, which number is it of was it of RESPA? Or no, was it RESPA? It's part of
the high price. Yes, it's RESPA, so section 35.
635. And
then
percentages.
Yes, and then one thing I forgot to mention earlier was the high price is under TILA, and then the high cost is under people pronounce it differently, but HOPA, HOEPA.
That's right.
So the high price is 1.5% for the first lien, 2.5% for the jumbo first lien, and 3.5% on the subordinate liens.
Very good.
And then we use APE like the acronym APE to remember that they must have the ability to repay, no prepayment penalties for the first 2 years, and must have escrow for the first 5 years.
Very good. What about high cost mortgage loans then?
So then high cost is section 32, and again that's under HOPA. Right. And that is 6.5. It's when the APR exceeds the APOR by 6.5% on the first lien that's $50,000 or more, 8.5% on the first lien that's $50,000 or less, and then 8.5% on the a subordinate lien.
Very good.
And then we use the acronym BAPS. So there's no balloon payment. They must have the ability to repay, and no prepayment penalty,
Mm-hmm.
and they must speak to a HUD counselor.
Yes, yes, it's a lot. Wow, we've covered a lot of material.
Yes.
Yes. All right. How are you
Yes.
feeling? I mean, we've been going on for like a while now. I don't want to like, you know,
I
like
well, this is my
how are you
transparency. I am feeling like I'm ready to eat some
feeling?
food
Right. That's what I'm thinking. That's what I'm thinking. Okay. So this is perfect.
and get
Perfect. Perfect. All right.
some
You
sleep.
did.
I love y'all, but no, this has been it's been great because we've gone through so much stuff, and
Yes.
like it's all about repetition anyway.
Right.
That's how we learn. So I feel like we've covered so much, and just really hope it's helpful to so many people out there.
Yes, 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 yes. Thank you again for like doing this. This is amazing. We did like 2 full sessions in this thing, right? You know what I'm saying? We
Yes,
did all
no,
the ones from, so that was great. And then
yeah,
also,
no,
again,
thank you.
I know we've been like giving shout outs throughout the video, but just to emphasize, special shout outs to Rocky, to Jen, right? That
Yes.
excellent cheat sheet she put together. Sumera,
Sumera,
we got a lot
yes.
of questions from Sumera. Also, Jack, who's been contributing a lot to the group, and Ed, and Cynthia, and Lawrence, and also Charlie. Charlie's the one that started this group, with Rocky, back, way back, And so we thank you all for that. Thank you for watching. And just make sure that, hey, if you've noticed any like errors and anything that we've said, make sure you let us know too, because a lot of material, so
Yes, exactly. It's a lot of material. We will like go through some things and see if there's, we can edit if we can, but otherwise like just put it in the comments and we can that way people can see so the correction can be made. But then also just one last thing I just wanted to mention is, all of the material, everything that we use, like as far as material stuff comes from Affinity Mortgage. So just really want to give a shout out there. A lot of the tricks and acronyms and all that stuff comes from this amazing study group and from Jen's cheat sheet, but a lot of the material itself is from Affinity Mortgage. So definitely want to give a shout out to them.
yes, yeah. If you're not already signed up with the mastery course, make sure you sign up, pay for the Affinity Mastery course, right? Because then you'll be able to get the 800 facts, and you'll be able to get like the full material, right? The detailed material. And it's really, really great. And also too, if you're not signed into the study group, make sure you get into the Facebook study group. It's called Study Buddy, the Study Buddy group, so make sure you get in there so you can connect with Rocky and take Rocky's, daily classes and everything. So awesome.
Yeah, it's incredibly helpful, you guys. Like this is a huge amount of material, but truly like it's the test is such a beast, as we like to say, that there's so much more information. So we truly need like the information from Affinity, and then Rocky's like the study group is, they have like a 92, or we have a 92% pass rate. So a lot of times people are not passing the test and they end up finding our group, and this is what they're utilizing to pass the test. So highly recommend it. Thank you so much for this, Lance. I so appreciate you. I'm grateful for your time. Thank you.
My pleasure. Thank you. Have a good night.
Bye, you too.
Bye.